Hello, everyone. This is Ted Bauman here with Clint Lee for Your Money Matters on this Monday. We record this on a Friday, so there's no telling what happened over the weekend. Hopefully, Congress was able to pass the stimulus. The last news we heard was that one congressman from Kentucky had objected, and therefore all the Congress persons were going to have to come in and vote. Don't know whether that's changed over the weekend, but if it is, that will definitely make the markets nervous. Clint, how are you doing today? How are things at your house?
I'm doing well, Ted. Thanks. It's nice to see and speak with you. It's not someone that's a member of my household. We've been cooped up now for about 2 weeks, but we're holding in strong.
Yeah, it's pretty strange, I have to say. I mean, I've started feeling a little bit stir crazy this morning. Then I remembered I could probably go up to the boat this weekend and sit out on the lake all by myself with the family. So we might do that just in the middle of the lake and drift around, even if there's no wind. At least there won't be any virus, hopefully. Today we want to talk about whether we've reached a bottom or whether we can start talking about a bottom in the market. But Clint, you and I have been talking, and we doubt that. Can you tell us why we think that?
Yeah. So one of the things I'm following closely is the level of VIX, and we'll actually call up a chart here to show you exactly what we're talking about. Now, the VIX is nothing more than an index of what traders are expecting price swings to be like over the next 30 days or so. So when things are calm, when the day-to-day price movements are relatively low, this level of VIX tends to be typically below 20. But as things start to widen out, as markets become more volatile, the VIX index, a lot of times it's called the fear gauge, that starts to increase. And so what we can see here is that we still have a VIX index that's above 60. And I'm pointing out this 60 level because as the S&P has had this bear market rally, as you've put it, the VIX index hasn't necessarily kept pace with what the S&P is doing. And what I mean by that is as the S&P has gained substantially just over these last few days, there's been a little bit of a floor on the VIX declining. We would like to see the VIX decline by a larger magnitude than what it has as we've seen these price gains recently.
I think that's a good point. And I think, a couple of weeks ago, we spoke about the notion of a dead cat bounce, that the market might recover over the short term, but it doesn't mean that the bear market is over. And we spoke then about the importance of a confirmation in terms of volume of purchasing over several days. But here's another factor that if the options markets are expecting volatility, that means that maybe the purchasing we're seeing is just a short-term something going on. People are grabbing value where they can see it, and that's not necessarily the bottom of the market. And I just want to flash up a couple of charts also to confirm that. The first chart I want to show is this is the period between the peak of the market prior to the 2008-9 crash, right up to the day when the market turned in March of '09. And as you can see, it kind of had a slowish downward trend during the course of 2008, but then big crash in September. That was the bear, the Lehman episode. But you can see in that quadrangle that I've drawn there that there's a bunch of dates when the market ticked up, and sometimes it ticked up over several days in a row, but it kept going down. And if you start from the very top of that, you can see that the market actually lost something like another 15, 20, even 25%. Now, the next chart I want to show you is the more recent period. This is also SPY. This is the S&P 500 main ETF. And as you can see, we've got a very similar pattern going on. We see a bunch of attempted recoveries and then another drop. Right now, it's difficult to say what's going to come after the end of that period because it's still ongoing. But I think the message is that there could be more down days coming. These temporary reversals are something to be aware of. Clint, what's your take? I mean, we spoke before about what is required for us to know that the market has bottomed and is going to turn around. Can you briefly summarize what, from our last discussion, what we see those as?
Yeah, well, I think at this point, just to summarize a couple of the outstanding items we need to see, I'm just going to term it visibility. We need visibility that the number of new cases with this virus is starting to peak or has peaked, and we're starting to see a flattening out of the curve. The timing of that really then starts to play into how long the economy is going to be shut down. Because, let's face it, the constraint on economic activity right now, the surge in jobless claims we saw the other day, this is all having a tremendous impact on corporate profits, and that's what the market's reflecting. And so it's not until we start to get better visibility on how we're going to be able to flatten the curve and for people to start getting back just to the day-to-day lives and getting back to their jobs, that's ultimately going to be the signal that we're looking for to say that there's a bottom in place.
So really, I mean, as a couple of people have said, I've seen the quote a couple of times, the virus dictates the timeline here. And one of the other things we spoke about was seeing a turnaround in purchasing managers' sentiment if they begin to see an uptick. But what I found fascinating today, when I was looking at the news earlier, is that the Chinese are starting to say that the biggest constraint on their recovery is the fact that US and European customers are not placing orders. And so what we have is a situation where the fact that this whole thing is spreading around the globe in stages means that even economies that have recovered a bit, like China, are still going to face demand side constraints of their own, which really raises the question of what investors should be looking at right now in terms of potential defensive or even value plays. And on that score, I wanted to share another graph. This one shows a bunch of ETFs that are commonly used to track different sectors. And this shows their performance since the beginning of the year. At the very top is the XLK, which is the technology ETF. The next one is XLU, which is utilities, a classic defensive sector that pays good dividends usually. And then you get consumer goods, XLP, and then healthcare. But I think, and those are all above the level of SPY. In other words, they have, as sectors, performed better than SPY as a whole.
I have a question about this for you, Ted, because we were talking about this earlier. So utilities, staples, healthcare, that makes sense to me on why those would be doing as well as they are, or that they're at least holding up better than the S&P. What do you think it is about technology that's XLK on here? Technology has been the best performing on a relative basis. Why do you think that's so?
Well, I think ultimately it comes down to two things. One is that technology is playing a critical role in this current situation. We're seeing companies that provide remote video conferencing techniques and capability like the one we're using that have been bumped up in the market because people are working remotely. So there's some of that. But the other one is that these are just the biggest companies with the deepest reserves of capital. And if anybody is going to recover quickly out of this market, it will be them. Companies like Apple and Google, Amazon, they're all sitting on piles and piles of cash. And they're not at any risk at all of going out of business over the course of a 6 or even 9 month or even 12-month disruption to the economy. And I think basically people are saying, look, right now they are the safe haven stocks. They're kind of like what the big Nifty 50 stocks were back in the 70s and 80s. The big industrial stocks. That's the role they play. But I want to show a second chart now, and that is the comparison, basically looking at the same set of ETFs, but for this past week. This was the week prior to recording this. And you'll see that at the very top is XLE, which is an energy stock. Now that, as we know, with oil prices at the levels that they are, that it's hard to understand why that would be the case. And right after that, you then get XLI, which is industrials. And we also know that these are companies that are being severely impacted by the virus. Now, at the bottom, you see healthcare, you see basically under XLY, or sorry, SPY, you see technology, you see utilities, you see healthcare, you see consumer staples. So it's a reversal. Why do you think that would happen? My take is that people are looking for value in these sectors, and they're bumping it up, but it's not the basis of a sustainable recovery.
Yeah, I think there's really two explanations that it could come down to your point. I mean, it's basically taking the first chart you showed and flipping on its head with what's done well recently. And I'd say it's either bargain hunters out searching for value, but then I also think it could be a lot of short covering. People that have been short these names, short these sectors, the stocks that make up these sectors are sitting on some very big profits right now. And it's only natural to want to take some of those profits from time to time. And so in order to come in and cover those shorts, they have to buy the underlying securities, and that in turn has the buying pressure to boost those prices. With what we've talked about so far, with what we've seen in this market, with what volatility is doing, my inclination is to say there's probably more short covering going on here than it is actual institutional investors going in and buying these names for the long haul.
And I think that, in a way, that is probably one of the biggest lessons from today's video, is that the volatility that we're seeing, these temporary spikes that we're seeing, they go back to the different structure of the market, the fact that a lot of these short selling activities are now part of computerized trading, and this has increased volatility dramatically. I actually sent out in a video to our Alpha Stock Alert subscribers last week a detailed explanation about this. And one of the things I pointed out was that when the big institutions that sell options, whether they're calls or put, that when they do this, they have to basically undertake short selling themselves in order to protect their positions, having sold these options, and that contributes to the volatility. In normal times, it actually moderates volatility, but in this crazy situation we're in now, it actually leads to increased volatility. So that goes back to the key thing. We showed you earlier a graph that shows how different, or how there are peaks on certain days, but they are not a reliable guide to recovery. So again, the virus dictates the outline here, and there's we're not experts in that. We have to hang on. Let me just close by asking this, Clint. Do you think that the sectors that we saw that have experienced strength since the beginning of the year are good bets? Should people be considering investing in these ETFs like XLK, XLU, etc.?
Yeah, well, I think to what you pointed out earlier, I mean, with XLK, I mean, these are largely made up of some of the largest, most stable companies in the world in terms of, when you look at their cash flows and their balance sheets, and they're likely to be the ones best equipped to make it through this in the long run. But here's another thing I'd point out is, even though those are the best performing sectors that we're seeing, they're still down. You can still go in and buy shares of technology companies, of healthcare companies, of utilities companies, of stable companies at cheaper prices, at lower prices than what you could have got them at the beginning of the year. And these are the ones that are providing stability. In a lot of cases, these are the ones that will be able to maintain their dividends. So by buying them at a lower price, you're able to boost your dividend yield versus what you could have done at the start of the year. So yeah, I think it's a good idea, a better bet to stick with what's worked so far this year instead of chasing the perceived bargains in some of these beaten up sectors.
Right, and just as an example, I mean, XLK, for example, I've been tracking that one closely as a bellwether since the beginning of last year, and at one point it was up over 40%. From the beginning of 2009, only the other day did it come back into positive territory. It had actually fallen by that much and started to climb back. That just tells you it has that much potential upside when it gets back to where it is. So that's what you want to look at, folks. And I think the message is, although we don't know which one of these daily spikes is going to turn out to be the one that represents the bottom of the market, for now it's a good idea to look at the winners, the ones that have survived so far this year. That would include your technology, ETFs, utilities, hospitals, and consumer goods. But remember, the best thing to do is to buy them in small chunks, because you never know on which day they might actually go down again and present a better opportunity. So whatever you do, buy them in bits. Whatever your intended investment is, do it day by day rather than all at once. Anyway, that's all for us today. Remember, the Bauman letter is there to support you. We have an outstanding report coming up soon, which is going to be the most comprehensive survival guide, I think, to a bear market that I know that I've ever worked on. And I think it's going to be a great opportunity for people who are looking for ways, not just to profit, but also to save money, to have defensive investments that will gain a little bit no matter what happens, and also just how to save money in their daily lives. So remember, folks, have a look at that link that takes you to the Bauman letter and consider subscribing if you don't already. Anyway, that's us for the week. We'll talk to you again next Monday. Thank you very much.
Thank you.